Well, welcome to followmetrades.com Basics of Trading webinar. Glad you're here. And I'm going to turn my camera on for just a minute so I can introduce myself, and then we'll get started into the material. So, like I said, I'm Dean Jenkins. I'm the founder of followmetrades.com. I've been trading and investing for over 25 years. And this is now the 6th year since I started my company, followmetrades.com. I offer stock alerts service trades to subscribers and help them manage the trades. And I have a variety of educational products for people wanting to learn how to trade. And I also offer one-on-one coaching and mentoring. So again, I'm Dean. There's a real guy here behind the screen, and then I'll turn the camera off so I'm not a distraction, and we'll get into the material. So please, as we go along, ask questions. I assume you're here, because of the title, Basics of Trading, and you either are interested in getting into trading or you already have started. You have some questions, you've been doing it for a while, and you're just looking for tips and pointers and help. And I hope to provide, all of that during this session. Make it as good for you as you can by asking questions, and I'll do my best to answer them as we go along. So just a quick note, a disclaimer. I'm going to be looking at some live markets, some real charts, giving my opinion on some things. Right? Trading and investing involves risk. You can't escape that. I'm going to talk about risk control, but I'm not a financial advisor. I'm not giving financial advice. And again, trading and investing, no matter what other people may tell you, it always involves risk, and risk has to be managed at all times. So here's what we're going to cover today. And again, I can take on different topics if you have questions, but we're going to talk about real quickly, trading versus investing. What's the difference? Because we're going to talk about trading today. We're going to talk about the 5 habits of successful traders. And again, I've been doing this a long time, and I've worked with and coached a lot of people, and there's some major themes that have emerged for people who are successful, and we'll cover that. Going to talk about risk management. It's the single most important topic when you talk about either trading or investing. You have to manage risk. The markets involve risk, but you can control it, right, to an acceptable level. So we'll talk about how to do that, some ideas, some tools. Choosing what to trade. It's an interesting and important topic. So we'll talk about that a little bit. We'll look at some charts, and I'll offer some quick teaching on just looking at price action, looking at charts, how to interpret that. We'll look at order types. We'll actually place a couple example orders and actually buy and sell short some shares to demonstrate how to place orders. And then Q&A. And if you have any particular stocks or ETFs you'd like me to offer my opinion on, I'd be happy to do that. Again, I'm not a financial advisor, right? But if you want to know, hey, what's going on with Apple or Microsoft or Amazon or whatever, right? I'll be happy to pull up the chart and use my techniques and offer my analysis. So that's what we got coming up. So let's rock and roll on it, okay? First topic here is trading versus investing. So investing is typically buy and hold, right? An investor is going to, try to find a quality company, Apple, Amazon, whatever, and they're going to buy the shares and they're going to hold them for a long period of time because they believe in the future of the company. They believe that the company will grow their earnings, the price will go up over time. So when you hear, like Warren Buffett and other investors, that's what they're doing. They're buying shares in a company or in an ETF, and they're holding them. And that hold time is going to be typically years, right? And they're willing to sit through ups and downs, and ultimately, they expect to be rewarded for that. That's investing. Trading is different. Traders understand that the market has cycles, that things go up and down, and trading is typically on a shorter time frame than investing. And so traders try to take advantage of these cycles up and down and make money on the stock or the market movements either way. And so trading is what we're talking about here. And just to differentiate trading from day trading. So trading can be done on any time interval, right? I'm what's called a swing trader. I take trades, and I'm in them typically between 2 weeks and 6 weeks. Okay, so that's way different than buying Amazon 10 years ago, right? I'm in it about 2 weeks to 6 weeks on average. Okay, you've probably heard the term day trading. Day trading is, a lot of the same concepts and techniques and tools apply. It's just a much shorter time frame. Day trading, by definition, means you buy some security, a stock or an ETF or something, and you're going to sell it before the end of the day, before the end of the current day's trading session. So it's very, very short term. Day trading is very difficult. It is the most difficult because it's happening very fast and there's a lot of emotion involved. The swing trading I'm doing, 2 to 6 week hold time, you have a little bit more time to think about your entries, to qualify trades, and then to let them play out. And I prefer it's a little bit more relaxed. But those are some important differentiators between investing, trading, and day trading. Okay. So let's talk about the top 5 habits of successful traders. And I've got a video series. When you signed up, I think you got an email with a link to this. So there's more depth and there's some training that it's free. You're welcome to check it out. But let me go over this. So again, I've been doing this for a number of years, and I've run this company this is my 6th year, and I've coached and mentored and trained hundreds of traders and talked to thousands. And these are the top things that emerged in terms of, a contrast to the mistakes people make that cost them money. And then what are the behaviors and the habits of people who are successful, right? And so the first thing here is having a trading plan. And, a trading plan can take many different forms, but everyone I've seen who's successful at trading has a plan. And we'll talk some more about what the attributes of a plan are. The other thing is following the trading plan. It's one thing to have it. And that sounds, kind of obvious, but, you got to have a trading plan, a written down script, of what you're looking for. And then you got to follow it. And those are different things, right? Some people can create a trading plan, but then they break the rules. And if you're going to be a consistently profitable trader, it requires discipline, and you got to actually follow your plan. You have to use risk management. You have to control loss. And we're going to spend some time on some techniques, some ideas for that. You got to respect the math of trading. You got to keep your winners big and your losers small. And we'll go into some more detail. And it gets, when you begin to understand the simple arithmetic of trading, it takes the pressure off, because you don't feel like you have to win every trade, because guess what? You're not going to. Some are not going to work out. You're going to lose on some. But if you understand the basic arithmetic and approach, the math of trading, then a losing trade won't trouble you, right? And it is coupled with risk management. And then the last thing is not chasing shiny objects, and we'll talk about that. Okay. So let's talk about our trading plan, right? A legitimate trading plan includes, at a minimum, the exact criteria that need to be met when you're going to enter a trade. So what that does is help you from, just operating off of hunches and guesses and, what your coworker told you or the neighbor told you, or, whatever, right? Somebody you met at a party and they go, oh yeah, here's this, I got this really, I just know that such and such is going to happen with NIO, the Chinese Tesla company, and you should just go buy it and it's going to go up 10 times, right? You don't want to act on that kind of stuff, right? You want to have some very specific criteria for entering a trade. And we're going to look at charts, and we'll talk a little bit about indicators, measurements of what's going on with price. And that's really where I live, is in analyzing a chart, tuning out the noise, and just trying to come up with a edge, right? That there's a higher probability of this thing going the direction I want than there is of it going the other way. Right? You got to have the exact criteria for exiting a trade, because it can be very stressful. You get into a trade, and even if it's winning, then there can be some confusion about, okay, what do I do next, right? You get into a losing trade, that's stressful, right? You're losing money, and that's, we're going to talk about risk management, where we have a floor, the absolute minimum that we're willing to lose on a trade. But it's even stressful to be in a winning trade, and you go long, you buy some shares, and you're making profit. Now you go, what do I do? when do I get out? Because if, the tension is, well, if I stay in, I'm going to make more money. But if well, what if it goes the other way and I have profit and then I give it all back, right? So it creates some stress. And so there's rules. You can script that ahead of time. So when you get in the trade and you begin to experience the emotion, that doesn't drive the decision making. You've already laid out a roadmap about what you're going to do, what actions you're going to take. It's all written down in a plan, right? And you have to write down how you're going to manage a trade. It's smart to take partial profits along the way and then exit. When am I going to close this trade, right? So a trading plan includes all these things. When am I going to get in? How am I going to manage the thing? When am I going to get out, right? And that just reduces stress, and it takes, to a large degree, the impact of emotion out of the trading. Okay, risk management. There are lots of trading systems with indicators and setups and analysis, right? Lots of them work, lots of them can work. There's 1,000 different ways to analyze charts and decide whether to take a trade or not, right? Regardless of the analysis technique you use or the indicators you use, risk management is unchanging. It's the same no matter what. And so risk management, successful traders manage risk because they understand and they accept at a very deep emotional level, right, that any trade can fail. No matter how good the setup and how sure you are that it's going to work out, you have to accept that it just may not work out. It may fail. It may end up being a losing trade. So what we do is we determine how much we're willing to lose before we get into the trade. The obvious thing is to go, how much am I going to make? Man, this is going to be awesome, right? I'm going to get into this trade. I'm going to make a bunch of money. But really the first and most important question is, how much am I willing to lose? And then successful traders, I'm going to show a formula and an example for this. They don't take a fixed trade size. That's a mistake to go, okay, I got a $50,000 account. So I'm going to put 5,000 into every trade, right? That's a mistake, actually. I'm going to show you a formula for how to figure that out based on what the realities of what's going on, right? So they don't take a fixed trade size, and then they exit the trades at a predetermined loss level without exception, right? There's no decision to be made. If it hits this predetermined exit point that we call a stop, close the trade. We don't blink, we don't second guess it, we close the trade. And then we're not upset if the trade fails. We know that it's a system, right? And that's the last bullet point on the slide here, is that successful traders understand that trading is a system, and that it's the system performance that matters. It's not what happens with a given trade, right? So that leads us into this next really cool topic, which is trading math. So successful traders operate kind of like the owners of a casino. It's a good way to think about it. Right? If you think about a casino, right, there are players on the floor engaged in the various floor games who are gambling, right? The odds are stacked against them. Now, some of them may win, some of them may lose. Hopefully, they are there for entertainment. They're just there to have fun and not expecting to make money, hoping to make money, but really there to have fun. Go with your friends, have a few drinks, play some games. Right? The casino owners are not gambling. Right? They have a statistical edge on every game, and they use table limits to control risk. So they know, like on roulette, you spin the wheel, right? And it's got red and black numbers, right? And then it's got a couple green numbers that actually tilt the odds on the roulette wheel. They know that they have a 52.5% statistical edge in roulette, that they are going to win 52.5% of the time, and they have a table limit. So they go, hey, you can only bet, $100 or $200, depending on the table. Right? So they know that's the max they're going to lose, right? And they know that in a given evening, across their roulette tables, a couple thousand spins of the wheel, they're going to win more than they lose. They're going to walk away profitable from that. and they will at the blackjack tables and the pai gow table and the slot machines, right? They have a statistical edge on every game on the floor, and they know they will make money, and they control how much they could lose. That's it. That's how successful traders behave. They only take trades that have the potential to win more than lose. They take trades that have a statistical edge, and they control loss. And there's two key statistics that successful traders use to evaluate their performance. And it's not the P&L, it's the win ratio, which is the percentage of trades that win, and the payout ratio, the size of the average winner to the average loser. And that needs to be a positive number, right? If you take 10 trades, right, and the average winner is $1,000 and the average loser is $500, that means you have a 2-to-1 payout ratio. That's a healthy statistic. If you have a 2-to-1 payout ratio, that your winners are on average double your losers, you only have to win half your trades and you can be profitable. It takes a lot of pressure off, makes the losing trades easier to deal with, right? Because they bum you out. There's no question about that. Right? Now, if we can push our win ratio up into the 60-70% range and we get a 2-to-1 payout ratio, we're very profitable as traders. Right? So it's important to think that way and not to fixate on any one given trade and to feel like a failure if one trade loses, because the market has a degree of uncertainty and just normal statistical variance, right? So no matter how good a trade setup looks, right, it can turn on you and you can lose. So we just control how much that would be, right? And we take it in stride. We go on to the next one and the next one and the next one. And over 10, 20, 30 trades, if we can generate some healthy statistics on our win ratio and more importantly, our payout ratio, we're going to be successful traders. It's a good deal. So let me take a little sidebar here, and let's talk about risk management and position sizing and stops and all that kind of stuff. Okay? It's a cool topic. And I enjoy looking at charts and talking to traders and trading. Here's a chart. This happens to be MJ, which is the cannabis ETF. Now, you'll notice on this chart that I'm showing, there are no indicators. If you've used a charting system or you've seen other people, you know, most traders have some indicators on their chart, and I do too. If I look at, this is my normal chart, you can see I've got an oscillator and I've got some moving averages and I've got an Ichimoku cloud here, right? They're helpful. But the most important thing to pay attention to is price. This is where the story is. And you don't want to have so many indicators that you can't see the price action and you can't read the story. That's price action tells you a story. Okay. And we don't need to overcomplicate it at all. You could bring this chart up, right? And you could go ask a fifth grader, go, hey, over this time period, did it go up or down? And every fifth grader is going to give you the correct answer. It went up. It's obvious, and you don't need indicators to tell you that. Okay? And then you could also ask that same group of fifth graders during this time period, what happened? Oh, it went down. And it is currently going down, right? So we don't need to overcomplicate it. We don't need indicators to tell us the obvious. Okay. Now here's the truth. There's a really interesting study of crowd psychology, and every big trend that goes up always, without fail, eventually corrects to some level. And then after this, I mean, it's just people bought it and there was excitement and there was news and people got in and they made money and then they start taking their profit, right? And then it goes down. And then this is a classic pattern. There is a high probability after this happens that it's going to go up again to new highs. This shape that you're seeing here is kind of lightning bolt. Happens time and time and time again. And it also happens on when something goes down dramatically, it'll often retrace up a little bit and then go down to new lows. It's an interesting pattern. It's called Elliott wave. The guy came up with this and noticed this back in the 1930s. And there's some rules, and you can kind of predict where that retracement's going to go, how long it's going to last, and then what's going to happen next. It's pretty cool, right? But there's a story being told here. People bought it, and now people are selling it, and they sold it big time, and now it looks kind of like they kind of want to start buying it again. Right now, you could have, we use some indicators and some things to try to figure out, what would prove that that's going to go up, and when would I take an entry? Okay, but here's let's say, for the sake of discussion, that I wanted to buy MJ right now at the current price, which is, call it $25.39. So I think it's going up. I want to buy it. So I'm gonna make this line. I like to mark my charts up so I can kind of see what's going on. So I use this blue line. This is where I'm going to get in. Now, there's another interesting theory. A guy named Charles Dow, in the late 1890s, he's the founder of Dow Jones and the Wall Street Journal. He wrote a series of articles in the Wall Street Journal called Dow Theory. And he said, hey, you got an uptrend as long as you have a series of higher highs and higher lows. Higher highs. Right? As long as, it's always going to pull back. Right? Even in an uptrend, you're going to get these little minor pullbacks. As long as these pullbacks don't go below the prior one, and as long as you put in new highs, you got an uptrend. That's Dow theory, a portion of it. And he also said, and it works in the down, right? So you got this downtrend, you got a low, right? Took out some other, and then you got a high, and then you got a low. And if you get another high, that means, oh, now it looks like we've got an uptrend, higher highs, higher lows. Right? So we're kind of wanting that to happen. And the point of this is, if this thing, it's got this, oops, I didn't mean to drag it, I wanted to draw. We got this low, and we got this high. If it goes down below here, we don't have an uptrend, we have a downtrend, right? This downtrend is continuing. So what I'm gonna do is say, well, that'd be the point where this uptrend had failed and my analysis was wrong. So what I'm going to do is go, if price goes below this level, I want to close the trade. Okay. So I'm going to make this line red. It's the danger line. We're going to call it our stop. Now, if price goes below this line, my theory about MJ going up is wrong. And it's still going down. So I want to exit the trade. That's my stop, right? And now what I want to do is figure out how much money I'm willing to lose if I buy MJ at the current price and then it goes down and hits that stop level and loses. How much money am I willing to lose? And that's how I determine how many shares to trade with, rather than picking an arbitrary number. So what some traders do is, like I said earlier, they'll go, I'm going to put $5,000 into every trade. And then they say, and if it goes down $500, I'm going to close it. That's my stop. Well, that's completely arbitrary. That's like saying, I'm going to get in my car, drive a mile, and then make a hard left, right? You're probably going to end up in the ditch, right? Because it's arbitrary. It's not based on the reality of what's going on. Because stocks, like I said, Dow theory, they go up and down, up and down, up and down. They stair step up in an uptrend, and they stair step down in a downtrend. Lower lows, lower highs, lower lows, lower highs, going down, going up, higher highs, higher lows, higher highs, higher lows. Right? And there is a average true range, an expected range that they would move in that trend. And if you have an arbitrary dollar stop loss amount on a fixed trade size, your arbitrary amount could be inside that normal range. So you could you could go, yep, I'm going to put $5,000 into the trade. If it goes down 500 bucks, I'm going to close the trade. And that $500 down move could have just been inside the normal expected variation in price in an uptrend. And it could result in what is the worst situation as a trader, nearly the worst, but nearly the worst situation as a trader, which was you were right. You were absolutely right about the trend and you lost money on your trade. Well, that's pretty miserable, right? The absolute worst thing as a trader is you blow up your account and you're broke. That's the worst thing. So nearly the worst thing is to be right about a trend and to lose money on the trade. No reason for that. So what we do is we figure out how much money to put in the trade based on my entry and my stop. We can also establish a target, right? We can go, how high do I think MJ is going to go? Now, I don't want to make this a symposium on Elliott Wave, but I can show you that, the tool I use is called Fibonacci Extensions. And so Fibonacci Extensions simply look at the up move, the down move, and project where the next up move is going to go. And so for this analysis, it's saying up above this green line. So let's just put in, a target line up here, and that's going to be green. So that's my profit. That's where I want it to go. Okay. So I've got an entry price, a stop price, and a target price. Those are useful data points. Okay. Now, the first thing you want to observe is look at the distance between my entry and my stop. It's this distance. And the distance between my entry and my target. Well, that's a good 5 or 6 times that. So this trade has a high reward to risk ratio. So in a few minutes ago, I said, it's really important that you have a good payout ratio, that your winners on average are bigger than your losers. Well, this is where that comes from, by taking trades that have the potential, a higher profit potential. If my target were here, well, then the risk is bigger than the reward. I don't like that, right? Even I got to win a lot. I got to win 80, 90% of my trades if the losers are bigger than my winners. So let's look for trades that legitimately have higher targets, okay? I got a calculator, a little spreadsheet I built here. And so this is a long trade. And so here's the formula, right? We go, what's our entry price here? It's 25.33. Stop price is 23.14. Let's say I got a $50,000 account and I'm willing to lose 2% of the account. You may have heard people talk about the 2% rule. It's a good statistical starting place, right? Is to use a 2% risk level. And a lot of people misinterpret that and they go, oh, 2% rule, I put 2% of my account into the trade. So $50,000, it means $2,000, I'll put $1,000 into the trade. No, that's not what it means. It means the most I'm willing to lose on the trade is 2% of my account, or $1,000. Okay. And so the formula here, it takes the difference between the entry and the stop, and that's your risk, right? 25.33 minus 23.14 is, just over $2 per share risk. Okay. Oh, the target is way off. Let me get this, 38.41. All right, so I'm willing to lose up to 2% of my account. I can change this. I can be conservative. I'm just going to lose 1% of my account at the most. Okay, $50,000 account, and it says, okay, if you're at 1% risk, you're being conservative. I'm only willing to lose $500 on this trade. It says, okay, buy 228 shares. This is going to cost you $5,775.24. And the risk is, it rounds for the price of the share, so it's $500. The trade risk is $500. You're going to put $5,700 into the trade, and if it goes down and hits the stop and fails, you're going to lose $500, or 1% of your account. And by the way, the reward to risk on this, based on the entry, the stop, and the target, is 5.97 to 1, nearly 6 to 1. How cool is that, right? If I'm right, I'm going to make, if I'm wrong, I'm going to lose 500 bucks. If I'm right, I'm going to make 6 times that, or about 3 grand. Sweet. That's what I'm trying to do here. That's the name of the game, right? All right. I said I was going to show, kind of how to place some orders and some order types. So let's do that. Market's open. I'm going to pull this spreadsheet to the side. Remember that number, 228 shares. So I'm using TradeStation here. It doesn't matter what your platform is. My order entry screen is going to look a little different than yours, but the terminology is going to be the same. Okay. So let's view the order bar here. And so MJ, and we said the quantity I want to buy is 228. Okay. The best order type for entering a trade like this is going to be what's called a limit order. Right here under the order type, hopefully you can see it. It's kind of small print. There, you can choose various order types. But you want to use a limit, and what you want to go do is look at what they're called the bid and the ask price. Right, the bid is 25.38. The ask is 25.42, and the market is like an auction. Right. Right now, the buyers are saying, I'm willing to pay 25.38. And the sellers are saying, I'm willing to sell at 25.42. And there is a 4-cent difference. It's called the bid-ask spread. Right? And the last trade was at the bid price, 25.38. So what I can do is, I'm in my simulated account. This isn't real money, right? I can go, I'm going to put in a limit. Well, I want to pay as little as possible. So I'm going to put a limit at 25.35. And I'm going to say, hey, this is only for today, right? You can change this, good to cancel, whatever, right? Different time frames, different situations, right? But this is simple. I'm going to buy MJ 228 shares, and I'm willing to pay up to 25.35. Okay. And then I click the buy button. A little confirmation. Are you sure that's what you want to do? Yeah. Here's our 57.79. Yeah, that's what I want to do. Okay. So the order is queued and is not filling. So apparently, the sellers aren't willing to sell it for that price. So I got to increase it. And what I'm going to do is I'm going to increase it in 1 cent increments until I get filled, as long as it's not too high. But this case, with this reward to risk ratio, it's not going to be too high. So let me do that. Trade manager. Oops. I pressed the wrong button. Sorry. Order filled. Oh, it just filled while I was messing around. Okay. So the price came down a little bit, and you can see there on the screen here, right? I got filled at my limit of 25.35, 228 shares, and I can look at my position manager, and it's going to be listed there, right? MJ, right? Look at that, 228 shares bought at 25.35. And now the next thing I'm going to do is go put in a stop order, right? So I'm going to do this. I'm going to go close this position, customize it, and I'm going to say this is going to be a stop market. So that order type says, if it hits my stop, I want this trade closed. Okay, my stop is 23.14. And I'm going to say this is good till canceled. It's not just for today. For as long as I'm in this trade, if it goes down to that level, I'm out, right? And there it is. You can see it's showing this little thing. Here's where I got in, and here's my stop order down here. So if I hit this price, the trade's just going to close automatically. Okay, that's how I do it. Now, some people don't like putting in stop orders. They worry about the market makers and all this kind of stuff. At a minimum, I would suggest putting in an alert. And any broker you have is going to have the ability for you to have an alert. So in TradeStation, here's my actual trades. Close this stuff, it's distraction. So in my actual trades, and you can see I've got alerts set. So if price hits a predetermined, my stop level, I'm going to get a text message from TradeStation. There's going to be a big pop-up on the screen that says, hey, alert, it hit that price you were watching. I'm going to get a big tone beep on the thing, and I'm going to get a text message from TradeStation. Hey, your stop was hit. And if you don't like having stop orders in place, at a minimum have a alert so that if this thing goes and hits the stop and it's time to close the trade, you get the alert, you log in, and you close the trade at the best price possible. Okay. That is how successful traders do it. That was a long trade. Let me show you a short trade. And this can kind of bend your mind, all right? This can kind of bend your mind. So I think everybody pretty well understands buying shares. Hey, I just bought 228 shares. If they go up to my target, I'm gonna make about $3,000, right? And I'll sell them up here and I'll be happy and life will be good and everything like that, right? But what about short selling? How does that work, right? Because we can make money if a stock or other instrument goes down. And quite often we make a lot of money because the market typically goes up. They said the market takes the escalator up and the elevator down. And if you remember, I got lots of lines on here. But if you remember last year about this time, right, there was our escalator through most of 2019 and early 20, and there was our elevator, right? There was a lot of money to be made there, and we did pretty well on it. All right, so let's look at, here's a current trade that I'm short, T-Mobile. Right, I got in about here, and it's heading down. Okay, so let's do that same quick analysis, and I'll demonstrate a short trade. So let's say that the appropriate stop for T-Mobile is here at this little high area. Make that red. Be consistent. And that I'm entering at the current price right here. This is blue. And that my target is down here at this prior low. I think it's going to go down here and bounce again like it has done the last 2 times. All right, green is my target line, okay? So let's pull our calculator back over. And let's say, oh, this is a short position. My entry price is 121.18. My stop price is 129.96. And my target is 107.91. Okay, it says, hey, you gotta, and let's do the same. Let's be consistent, 50,000, 1%. So you get a 1.51 reward risk ratio. So that's not bad. It's not as good as 6, but it's not bad. And it says, hey, you should, in a $50,000 account with a 1% risk level, 56 shares is the appropriate number to trade. You notice there's a second box here on both these. These are constrained. So sometimes if your stop is really close to your entry, and I'll demonstrate that. Let me make this. What's going to happen is that it's going to those formulas are going to suggest a very large position, which is not going to be appropriate. So let's do just fun 122, really close, right? So yeah, the initial suggested position is going to be 73 grand, which is we got a $50,000 account. So it's going to say, hey, we're never going to put more than 15% of our total account in any one given trade. So it's going to constrain it to the 61 shares. Okay, so that's important. But given the real stop and entry and target prices, yeah, 56 shares would be the appropriate number of shares to trade, and that's a $6,700 position. Notice that's not the same as our long position. It's all based on the trade parameters, right? But the amount we're going to lose per share on the trade total is, again, rounded. It's going to be $500, rounded price of the shares, 56 shares. So let's short this thing. Here's my order bar, and now it's T-Mobile, and we said it's 56. Yeah, 56. We're going to short at 56 shares, right? We're going to do a limit, right? Our limit price, now we're going to use the ask, right? Because we're on the other side of it. So we're going to use 121.30. It's really tight, 121.27, 121.30. Let's just come one penny inside and try and get filled, 121.29. Now, rather than buying, I'm selling short. I'm going to sell shares that I don't own. And then I'm going to buy them later. And the way this works, I'm going to sell them. And it, again, it'll kind of bend your mind, but just keep it real simple, right? I'm going to sell them hopefully for 121.29. And then when it goes down, right, I'm going to buy them back. I'm going to buy to cover, because when I sell short, it's actually a loan. My broker is loaning me the shares. And it says, I'm going to loan you shares that you can sell at 121 bucks. And at some point you have to buy shares to cover that transaction. And what I'm hoping is I get to go buy the shares to cover that transaction at $107.91. And then how cool is that? I bought shares at 107 and I sold them at 121. That's how it works. Okay. And again, don't your broker takes care of all the back office stuff to make that happen. It's pretty cool. So this is good till canceled, or no, this is going to be day only. For our entry, we're just, we're going to try and get a good price. This day only, sell short. And it didn't fill. No worries. Here's the correct app that I want, Trade Manager. And it says, hey, here's your T-Mobile. So let's just go ahead and cancel, replace this, customize it, and say, take it down a penny. See if that fills. Oh, and the price has moved quite a bit. You can see the bid and the ask here. So let's go down to here. So that what you can see these fills in a simulated account they're synthetic. They're not real, right? Order filled. There we go. It finally filled at 121.26. Okay. And then I'll do the same thing. Now I would put in a stop order, and we set the stop on this is going to be 129.96. So I'd take this position graph bar. Here's T-Mobile. Well, look at this money. I'm making 24 bucks on MJ already. Close this T-Mobile, customize it, and now this is going to be at my stop price, which is 129.96. I want this to be a stop. And this is going to be good till canceled. And this now the transaction is buy to cover because I sold short, right? There we go. So those are just some demonstrations of actually placing orders and taking positions on T-Mobile and MJ. And we close these. All right, and again, if you got questions, chime in here. All right. So hopefully that demonstration was helpful. Let me move on with a few more points that we wanted to make here. Okay, we left off here with trading math, right? And we kind of got into risk management, how to set up position sizes and all that kind of stuff. That was fun. So here's another thing that successful traders don't do. They don't chase shiny objects, right? I'm sure if you found this webinar on the internet, you've seen 20 other offers, right? And people are always, it's an interesting sector of the this sector of people that provide trading services, right? There's some really good folks. I try to be one of them, and there's some snakes. There's some absolute con men and criminals, right? And this whole thing is very seductive, right? Because you get to work from home and use your computer and you can make money, and it's true, and people really prey on that, and then they offer other crooks, right? And it can be hard to tell who's legit and who's not, right? There's going to always be something new promoted. Again, this idea of making money at home on your computer is just very seductive, right? And there's people that take advantage of that, right? So successful traders do continuously learn. They do try new things, but they're very careful. They're very skeptical, cautious, and they're disciplined, and they get proof and they test things before they're implemented. And just, I don't know if you checked out my website before you came here, right? I do my absolute best to be legit and all that stuff, right? It matters to me. So I list the returns that I'm getting on my website, over several years, right? Here we are year to date. We typically are, 25 to 30% is the average return. We typically beat the indexes, not every year, but over time we've done really well. I list the details of every single trade that make up that result. And I have this audited by a third-party CPA firm, and those reports are on my website. So what I say I'm doing, I'm actually doing it, right? I'm not saying you're going to take $5,000 and make $1 million. I'm saying, hey, we're getting some pretty solid returns. We're beating the indexes. And, if you look at 2020, right, what made up those numbers? Here's my trading statistics, right? My win ratio was a little bit low last year, but my payout ratio was 3.3 to 1. My average winner was way bigger than my average loser. And there's a listing of every single trade I took. Symbol, the date I got in, date I got out, whether it won or lost, how long I was in it, details. So yeah, that's what I'm doing. All right, don't chase shiny objects, right? So that really is the presentation of the basics of trading. We could go on for hours, but I think that's a pretty good starting point. And again, you got an email that gave you access to the top 5 trading habits, and part of that there's a 5-part free training video series about trend analysis and risk management and some other topics, right? So there's more detail there, and you've got access to that for free. So I said up front that I run followmetrades.com. It's a trading service, and I offer stock alerts, got a live trading room. I have training products and mentoring. So, if you're interested and like what you saw and you want to, kind of check it out more, I got an offer for you here. You can participate in my stock pick service, right? Take a trial, 30 days for $37, just about $1 a day. And then it's $97 a month after that trial. And that's a discount off the list price on the website. And that's got 100% money back guarantee. So hey, I want to check this out. Take a trial for 30 days for $37. And if at the end you go, hey, it just wasn't a good fit, no questions asked, no hard feelings, I'll give you a refund. Just ask, right? Most people stay because we're making money. It works out pretty well. If you're interested in that, I'm going to post a link here in the chat box, so you can check the chat box out and just hit that link if you like. I don't like that. That's not the right link. Sorry. It's because I clicked on that from another link. There we go. Here's the right link. That other one probably would have worked. There you go. So there's a link if you'd like to take a trial, check it out, and what's included with that service. Here's what you get. You get the watch list of potential trades that I'm thinking about taking in our trading room. You get email, and now I've got a dedicated contracts if you understand those and are interested. I have training on that. You get alerts when I'm gonna, in the email and in the app, when I make a change, I'm moving the stop, taking profit, closing the trade. You get access to my live trading room. It's Monday through Thursday, half an hour right after the market open. And that's optional. A lot of people like to come in and, learn and see what's going on with the market and the trades, and have, myself and the co-moderator offer analysis on their trade ideas. And so we do all that. But it's you. If you don't want to come to the trading room, you can subscribe and you just get the alerts and go place the trades. It's just a bonus kind of thing, and a lot of people like it. We do have a weekly live chat session. If you can't make the mornings, Wednesdays, 6 p.m. Pacific, 9 Eastern, we have a session, just to provide support, answer questions, review the trades. When you sign up, you're offered a one-on-one consultation with me. So you get a link to my calendar, and we can set up time to help you get off to a really good start. And, after the consultation, if something else comes up, we can talk again. You can send me an email. I'm here to help you be successful, get started, use my service. I like doing it. And, if I provide good service and if you're successful, you're going to stay as a customer, right? I provide tools. You saw that spreadsheet. I got some other tools on the website and some training for risk management, for options trading, and ongoing support and training. I'm here to help. We do the trading room. We do the Wednesday night sessions. We do the consultations. You can email me anytime. And again, I want to see you be successful, because if you are, then I am. So that's it. Hey, thanks a lot for your time. I hope you found this session valuable. And like I said, I'd love to see you join the service, and it'd be fun to help you be successful as a trader. All right. And Neela's asking, where will Tesla go? Should I sell more? I think you're saying, or now? Would I please respond? You bet I'll respond. Here we go. Tesla. Let's look at it. I'm going to pull up my chart with indicators. Okay. So Tesla obviously has had a great run. And I have no idea where you got in at, Neela. But do you remember when I was talking about Dow theory? Right? So this was all a series of higher highs, higher lows. But if we expand current price, what do we see happening here? I'm going to blow it up so you can see it. What's happening now with price action, right? This was all higher highs, higher lows. Right? Beautiful progression. This is now low, lower high, low, lower high, low. You see what I see now? So I certainly would not be going long on Tesla at this moment. If I were long, right, I would probably, and again, it depends on, are you an investor? Are you a trader? You're just trading it for the short term. If I was trading it for the short term, I would be looking to exit and take my profit, hopefully, right? And I would have a pretty tight top, right? I would either close it now. I would close it now, or you could say, if it goes any lower, and this actually is a 50-day moving average. This is an important level. If it goes below today's low, I'm closing that trade, right? For sure. So that's my thoughts. Where will it go from here? Well, it looks like a real correction is beginning. So the Fibonacci retracement zone on Tesla is from here to here, down into this region. Now, this is not going to happen next week. This is going to take weeks to play out. But the probability, not the certainty, but the probability is that this is going to do this down into this zone somewhere. There's no certainties in the market, but this is the probability. So 4 months from now, we'll come back and look at this recording and see how I did. All right, did that help, Neela? All right, good. All right, any other questions from anyone else? Okay, one more. I'll do one more for you, Neela, and then we'll see if anybody else has any. CRSP, CRISPR. Okay, so CRISPR did what we were projecting Tesla's going to do. So you can see big run up and then lower lows, lower highs, lower lows, right into where? This zone that we predicted. This is the retracement zone, and you can see CRISPR made it. So now what do? We let this finish. Okay, we let this finish. And what we want is to see in this retracement zone, and right now it's lower lows, lower highs, lower lows, lower highs, lower lows. Could do a few more. At some point, what we want to see is a high, a higher low, and a new high. And if that happens, then the probability is that the uptrend will resume and it will go up above the prior high. But you have to wait for this to resolve and turn around before you try and go long on it. You can't try and guess because it could go clear down into here. All right. And that'd be bad if you were long and it went down to here. All right. That's how it works. All right, going once, going twice. Anybody else got any symbols, any other questions? Again, I'd be love to have you come on as a customer. If you got other questions that you didn't get a chance to ask here, feel free to email me, dean@followmetrades.com. Type it in. And I'll respond. All right. Hey, take care. No matter what system you use or who you work with or anything, be careful. Trade safe. Keep your winners big. Keep your winners big, your losers small. Use risk control at all times and have fun. Trading can be absolutely fun. It was great presenting to you today. I enjoyed it, and I look forward to some session in the future. All right. Catch you later. Bye-bye.